Merchandising operations. We're talking about owning a store and buying inventory and then selling it. And we're looking right now at periodic approach to purchases. And here's the problem. It says we purchased $1,150 of merchandise on credit, in other words on account, and the terms were FOB shipping point. Now we haven't talked about that before. Well, FOB shipping point stands for freight on board. Freight on board, shipping point. It's saying when the title to the goods passes. And the reason that title to the goods passage is so important is it determines who pays the freight to UPS or to FedEx or to the U.S. Postal Service. So FOB shipping point says since the title passes when it's shipped, guess who gets to pay? The customer. So if we purchase, will we have to pay the freight with these terms, FOB shipping point? Yes. The alternative to FOB shipping point is FOB destination, which means that the title to the goods doesn't pass till it reaches its destination, which means who owns it when it's being in the truck? You got it, the seller. So FOB destination means the seller pays the shipping. In other words, when you get those catalogs and there's this big sticker on the front that says free shipping if you buy $100, free shipping means what? FOB destination. FOB shipping point means buyer pays. So we're going to pay the freight here. So what's going to happen when we purchase this? We're going to debit an account called purchases. Now this purchases account only exists if I'm under the periodic method. So remember, purchases account is only for the periodic method. So debit purchases $11.50, credit accounts payable $11.50. Then a few days later we get this bill that for the transportation costs, and we pay the transportation cost. Now that transportation cost is generally not to the what? Seller, it's to a third party, such as Yellow Freight, Mistletoe Express, FedEx, UPS, and so on. So we're going to pay it. Now we have a special account for FOB shipping point. It's called Freight In. So we are going to pay the freight for that merchandise to come in. So the name of the account, Freight In. And since we paid cash, we're going to credit cash for $150. So we paid the freight. Then it says a few days later, we return merchandise for credit. We said we don't want $180 worth of this merchandise. So what's going to happen? Well, we have to debit accounts payable because we don't owe $180 anymore. And now we're going to have a special contra purchases account because we want to track how much purchases are being returned. So if it's a bad vendor, we can stop using them. So we have an account called Purchases, Returns, and Allowances, or I've abbreviated Purchases R&A, 180. So notice I'm debiting accounts payable because I don't owe it anymore, and I'm crediting purchases, returns, and allowances, the contra purchases account. Oh, I know what. I bet on the financial statements when I come up with the total net purchases, that net purchases means the purchases account less the purchases, returns, and allowances account gives me what I truly purchased, or the net purchase. Isn't that fun? And finally, we pay in full. Well, when we pay in full, we look at how much do I still owe them. Well, I started out owing them $11.50. I returned $180. So the outstanding balance on my bill is $970, and I'll credit cash, $970. So these are the basic journal entries for the which method? Periodic method of buying merchandise to put on your shelves.